One of the biggest corporate frauds in American history was committed by a garbage company, an actual literal garbage company. Trucks, dumpsters, landfills, the whole thing. So today, I'm breaking down every major corporate fraud and everything we know about them, starting with the one nobody remembers: waste management. Waste management hit the Fortune 500 by the 1990s, a genuine American success story, except between 1992 and 1997. Executives were quietly inflating earnings by $1.7 billion, and they didn't hide it in some complex offshore shell company network. They hid it in depreciation schedules for garbage trucks. They just told auditors their trucks lasted longer than they actually did, then capitalized routine maintenance costs, as if replacing a brake pad was the same as buying a new vehicle. Nobody wanted to double-check the math on dumpster lifespans. I don't know what to tell you. CEO Dean Buntrock and CFO Philip Rooney eventually paid $30.8 million in civil penalties, which sounds like a punishment until you realize they got away with it for 5 straight years first. This was the canary in the coal mine, and nobody paid attention, which is unfortunate because the next company on this list made waste management look like a rounding error: Enron. Enron didn't just commit fraud. Enron made fraud a company value. They built an internal culture called the Enron Way that celebrated rule breaking as innovation. You weren't cooking the books, you were disrupting the energy sector. It was a cult with stock options. At its peak, Enron employed around 20,000 people and traded at $90.75 a share. Behind the scenes, they'd hidden billions in debt through special purpose entities, basically fake companies designed to make your real company look healthy. By December 2001, the stock was worth less than $1. That's not a crash. That's evaporation. Sharon Watkins, a VP at the company, tried to warn everyone. She wrote a memo to CEO Ken Lay essentially saying, "Hey, this is all fake and we're going to implode." She was right. Jeffrey Skilling got 24 years. Ken Lay died before serving a single day, which is, convenient timing. But here's the part that doesn't get enough attention. Enron's auditor, Arthur Andersen, one of the biggest accounting firms on the planet, went down with the ship. 85,000 employees lost their jobs. The auditor died too. But if Enron was the earthquake, what came next was the aftershock, and it was somehow even bigger. WorldCom. If Enron was the earthquake, WorldCom was the tsunami that hit right after. Less than a year later, same story, different industry. On July 21st, 2002, WorldCom filed for Chapter 11 bankruptcy, claiming the title of largest corporate bankruptcy U.S. history, a record it held until 2008, which is not exactly the kind of trophy you put on the mantle. The scheme was straightforward. Between 2000 and 2002, WorldCom misclassified $11 billion in regular operating expenses as capital investments, artificially inflating profits, and making the company look wildly more valuable than it was. The initial restatement alone covered $3.8 billion in improperly accounted expenses. CEO Bernard Ebbers got 25 years. CFO Scott Sullivan got 5. But here's the part that actually matters. The person who caught all of this was Cynthia Cooper, the vice president of internal audit. She literally walked around the company at night, pulling up accounting records her team wasn't supposed to be looking at, piecing together what the executives were hiding. Her internal audit team reported the fraud, despite enormous pressure to keep quiet. A VP with a flashlight and a spine took down an $11 billion fraud. I don't know what to tell you, but if WorldCom's executives were stealing with spreadsheets, wait until you hear about the CEO who was stealing with shopping sprees. Tyco International. Most of the frauds on this list involve some kind of clever accounting trick. Fake entities, hidden debt, inflated revenue. Tyco International wasn't that. Tyco was just stealing, like directly, with both hands. Dennis Kozlowski was the CEO of a $40 billion conglomerate, and between 1995 and 2002, he and CFO Mark Schwartz helped themselves to roughly $600 million through unauthorized bonuses, forgiven loans, and stock sales. Kozlowski alone took out a $137.5 million loan from the company and then just had it forgiven. Hey, remember that $137 million I owe you? Let's call call it even. But the real legacy of Tyco is the Perp Walk. Kozlowski was physically arrested and paraded in front of cameras like a common criminal, because that's what he was. That image changed how people saw white-collar crime overnight. Here's the kicker though. Their first trial ended in a mistrial, and it took a whole second trial before both were finally convicted in 2005. They each got sentenced to 8 1/3 to 25 years in prison. $600 million, and the justice system still had to take 2 swings at it. But at least Kozlowski only stole money. The next company on this list was playing games with something far more dangerous: people's medical records. HealthSouth. Most of these frauds involve elaborate schemes, shell companies, derivatives, off-balance sheet entities, stuff that takes a forensic accountant 6 months to untangle. HealthSouth said no thanks to all of that. CEO Richard Scrushy just walked into the accounting department and told people to cook the books. That was the whole plan. Between 1996 and 2002, Scrushy and his team inflated net income by approximately $2.7 billion. The method was almost insultingly simple. Lower-level employees were directly ordered to make improper journal entries. No hidden structures, no offshore anything, just hey, make this number bigger. And they did. At its peak, HealthSouth operated over 800 facilities. The stock sat comfortably around $30. Then the fraud came out and it cratered to under 3. Scrushy was actually acquitted in 2005 on all 36 counts of accounting fraud. Every single one. He was later convicted in 2006 on separate bribery charges and sentenced to roughly 82 months in prison, which, for a guy who orchestrated $2.7 billion of fabricated income, feels like a volume discount. But if HealthSouth proves that fraud doesn't need to be complicated, the next one proves it doesn't even need to be punished. Freddie Mac. Here's a $5 billion fraud that almost nobody remembers. And honestly, you can't even blame them. Between 2000 and 2002, Freddie Mac, one of the largest mortgage companies on the planet, systematically manipulated its accounting to hit earnings targets. They misstated their numbers by roughly $5 billion, understating earnings in some years, overstating them in others, whatever it took to smooth things out and keep Wall Street comfortable. That's not a rounding error. That's not creative bookkeeping. That's $5 billion of fabricated stability. The company restated its financials in December 2003. CEO Leland Brenzel and CFO Vaughn Clark were forced out. The SEC settled for $50 million in September 2007. 0 criminal charges. Not one, but here's where it gets almost poetic. A mortgage giant was cooking its books during the exact years that the mortgage industry was building the bomb that would detonate the entire global economy. Freddie Mac got placed into government conservatorship in September 2008, right as the financial crisis swallowed everything whole. Their fraud, which in any other decade would have been front-page news for months, just got absorbed into the larger apocalypse like a house fire during a volcanic eruption. And speaking of the 2008 meltdown, the next company on this list makes Freddie Mac look like a kid stealing from a tip jar. IGA. IG didn't just lose money. They hid $99 billion in losses using derivatives so complex that the people selling them barely understood what they were selling. And when the house of cards finally collapsed in 2008, the US government handed them $182 billion in taxpayer money, the largest bailout in American history. A company with 116 employees watched its stock go from $64 to under $1 in about 18 months. But here's where it gets fun. In March 2009, while the country was still reeling from the worst financial crisis in a generation, AIG executives paid themselves $165 million in bonuses. With the bailout money, with your money, employees started receiving death threats. Congress hauled executives in for hearings. The whole country collectively lost its mind, and honestly, fair enough. Now, the eternal debate with AIG is whether this was actual fraud or just catastrophic stupidity. And the answer the legal system gave us was basically a shrug, because criminal charges against executives were minimal to non-existent, which is, not ideal. But if AIG's collapse makes you angry, wait until you hear about the company whose bankruptcy literally froze the entire global economy overnight. Lehman Brothers. On September 15, 2008, Lehman Brothers filed for bankruptcy. $639 billion in assets. $619 billion in debt, the largest bankruptcy in United States history. And the trick they used to get there was almost insultingly simple. It's called Repo 105. Here's how it worked. Right before the end of each quarter, Lehman would temporarily move roughly $50 billion in loans off their balance sheet by disguising them as sales. Quarter ends, reports go out looking clean, and then the loans come right back. Every single quarter for years. It's like shoving all your dirty laundry into your neighbor's apartment before your mom visits, then dragging it back the second she leaves. But here's where it gets genuinely terrifying. When Lehman finally collapsed, it didn't just hurt Lehman. Credit markets across the entire planet froze within days. One company's bankruptcy nearly shut down the global financial system. That's not an exaggeration. CEO Richard Fuld walked away with $484 million in total compensation over his tenure. And despite a 2,200-page Examiner report that basically drew a roadmap of exactly what happened, 0 criminal charges stuck. They had the receipts, all 2,200 pages of them. Nobody went to prison. But if you think American corporate fraud is wild, wait until you hear about the confession letter that crashed an entire Indian tech giant overnight. Satyam Computer Services. Most of the frauds on this list follow a pattern. Someone gets caught, they deny everything. Lawyers get involved, and the truth comes out slowly over years of litigation. Ramalinga Raju skipped all of that. On January 7, 2009, the founder of Satyam Computer Services sat down and wrote a letter to his board of directors admitting he'd fabricated $1.5 billion in cash balances. Just wrote it all down. Yes, I did this. Here's how. Here's how much. Which is, not the standard corporate playbook. Satyam wasn't some back alley operation either. This was a NASDAQ-listed company with 53,000 employees and a client list that included General Electric, General Motors, and Philips. The market cap went from $2.3 billion to basically zero overnight. 53,000 people woke up one morning and found out their entire company was built on imaginary money because the founder decided to write a confession letter like he was journaling before bed. Raju got 6.5 years in prison in 2015, released early in 2019. But the confession letter is what makes this one stick. No cover-up, no shredded documents, just a guy admitting he lied about everything in writing to everyone. It's almost refreshing if it weren't so devastating. And if you think a written confession is a wild way to reveal a fraud, wait until you hear about a company that hid theirs for 2 entire decades. Olympus Corporation. Olympus hid $1.7 billion in losses for 20 years. 2 entire decades of executives looking at the books, seeing a gaping financial wound, and collectively agreeing to just pretend it wasn't there. CEO Tsuyoshi Kikukawa approved a scheme where they buried losses inside inflated acquisition costs, essentially overpaying for companies on paper so the real numbers would disappear into the transaction. And this worked for 20 years because Japanese corporate loyalty culture meant nobody questioned leadership. You kept your head down, you respected the hierarchy, and you absolutely did not ask why the company just paid $687 million for a British medical equipment maker worth a fraction of that. Then they hired Michael Woodford. Woodford was a British executive brought in as president, and he did something nobody at Olympus had done in 2 decades. He looked at the numbers and said these make 0 sense. He reported it internally. The board's response? They fired him, unanimously, within 2 weeks. So Woodford went to the media. Stock dropped over 20%. Kikukawa was convicted and received a 3-year suspended sentence, meaning he served exactly 0 days in prison for a 20-year, billion-dollar fraud, which is, not ideal. Woodford did everything right and got punished for it. The guys who committed the fraud got a stern talking to, but at least Olympus was hiding old losses. The next company on this list was hiding the fact that their entire product didn't work. Theranos. Elizabeth Holmes founded Theranos in 2003 with a promise that sounded genuinely revolutionary, a tiny device that could run hundreds of blood tests from a single finger prick. By 2014, the company was valued at $9 billion, and Holmes was the youngest self-made female billionaire in America. One small problem: the technology didn't work. Didn't work perfectly. It fundamentally did not do what she said it did. But here's the thing: Holmes personally convinced Wall Walgreens, major investors, and a board that included former secretaries of state that this thing was real. She showed up in a black turtleneck, spoke in a voice about 2 octaves lower than her natural one, and essentially said, "Trust me, I'm the next Steve Jobs." And they did. Every single one of them. Wall Street Journal reporter John Carreyrou started pulling the thread in 2015, and the whole thing unraveled. Investors lost over $700 million. Holmes was convicted on multiple counts of wire fraud in 2022 and sentenced to over 11 years in prison. People are still doing the voice at parties. This wasn't an accounting trick. This was a billion-dollar company built on a product that didn't exist, held together entirely by one person's ability to make a room full of adults believe in magic, which is almost impressive if you ignore all the fraud. But if you think a fake blood test is bold, wait until you hear about the company that invented $2.1 billion in cash that simply wasn't there. Wirecard. Wirecard was supposed to be Germany's answer to Silicon Valley, a sleek fintech company that processed payments for businesses across the globe, valued at 22 billion euros, sitting on Germany's most prestigious stock index. And in June 2020, it casually admitted that 1.9 billion euros on its balance sheet just didn't exist. Not hidden, not misclassified, just gone. As in, never was there in the first place. The money was completely fabricated, which is, not ideal. CEO Markus Braun got arrested and has been on trial in Munich ever since. His COO, Jan Marsalek, did something arguably more impressive. He fled the country and has not been seen since, just vanished, like the 1.9 billion euros he helped invent. But here's where it gets really uncomfortable. Ernst & Young, one of the big 4 accounting firms on the planet, signed off on Wirecard's books for over a decade. They never once independently verified the cash balances with the banks supposedly holding the money. Great, add that to the list. Short sellers and journalists tried to sound the alarm years before the collapse. Germany's financial regulator actually investigated the short sellers instead of the company. The stock cratered 97%, 1,800 people lost their jobs, and Europe got its very own Enron. But if Wirecard proved that traditional finance could fabricate billions out of thin air, the next entry proved crypto could lose them even faster. FTX. Every other fraud on this list took months or years to unravel. FTX did it in a week. 7 days from a $32 billion valuation to bankruptcy. That's not a collapse. That's a magic trick. Sam Bankman-Fried founded FTX in 2019 as a cryptocurrency exchange, and by 2022, it was worth $32 billion. SBF was everywhere. Magazine covers, congressional hearings, sports arena naming deals. He wore shorts and a t-shirt to meetings with senators and slept on a beanbag at the office, because apparently that's what genius looks like now. But here's the thing. FTX was a Ponzi scheme. His sister company, Alameda Research, was quietly borrowing customer deposits to make wildly risky trades. Over 1 million customers had their money in what they thought was a legitimate exchange. It was Sam's personal casino. Then, in November 2022, CoinDesk published an article questioning Alameda's finances. Binance CEO CZ announced he'd sell all his FTX tokens. That triggered a bank run, and within days, the $8 billion hole in customer accounts was impossible to hide. Oh, and he'd also made over $40 million in political donations with stolen customer money, so that's fun. SBF was convicted in November 2023 on 7 counts of wire fraud and conspiracy, then sentenced to 25 years in prison. The shorts and t-shirt didn't make it to sentencing. Corporate fraud doesn't stop. It just updates its wardrobe and picks a new industry. Every generation gets the same story. Some guy who figured out that if you move money fast enough, nobody checks where it's going, until they do. If you enjoyed this video and want to see more, click the video on the screen now.